All right. Happy Valentine's Day, everyone, and welcome to today's follow-up webinar to the webinar we did on January 24th, which was called 2018, the Year of Rising Risk. It is also a follow-up to the webinar we did on October 5th of last year, which was called Tracking Market Volatility Compression. Dr. Lev Borodovsky, Chief Risk Officer here at Star Mountain and editor of the Wall Street Journal's Daily Shot, presented both of these webinars and is going to present again today for us. I'm John Polis, and I will be your host today. I'm the Chief Technology Officer for your webinar sponsor, Star Mountain Capital. We are a specialized asset management firm focused on investing in the large and underserved U.S. lower middle market of companies with typically under $15 million of EBITDA. Part of our differentiated business model includes a custom-built media and technology platform, bringing proven large market resources to smaller businesses as a value-added lender and investment partner. Before I hand over the reins to Lev, I did want to let you know that your audio is muted and will be for the entirety of the presentation. Also, as a disclaimer, I wanted to note that nothing presented in this webinar or in the webinar materials we receive tomorrow constitutes an offer to sell or a solicitation of an offer to purchase by Star Mountain Capital interest in any investment product. This webinar today is going to be a shorter version. It's going to be approximately a half an hour. We have allocated time at the end of the presentation for some Q&A. If you have a question, you can type it into the Q&A chat box of your WebEx client. We will try to get to as many questions as possible before the 30 or so minutes is up. Now about our presenter. Dr. Lev Borodovsky has over 20 years of experience covering private equity, risk management, and operations. He was a founding team member, chief risk officer, and managing director of the GSO Blackstone platform, which was one of the most successful global credit and loan investment platforms ever. Currently, Lev is the Chief Risk Officer here at Star Mountain, and he's also the editor of the Wall Street Journal's The Daily Shot, which is a chart-based newsletter covering select global economic and market trends that is now obviously part of the Wall Street Journal. Lev, thanks very much. We have a lot of people that expressed interest in this on short notice, so a timely follow-up given everything that's going on in the markets. Thanks very much.
Thank you, John. And thanks everyone for joining. These are interesting times, and as we talked about in January, this year is going to be the year of rising risks, and we certainly saw that taking place. So today's follow-up, basically, we're going to take a look at the market correction, a little bit of a breakdown, a little bit of a dive into what caused it, what was it like, this recent equity stock market correction. Then we're going to talk about this volatility, what I call the big short unwind, which was a pretty ugly event that's going to reverberate for quite some time, even though this is a relatively small part of the overall market. The volatility markets have become pretty large overall, and it will have a broader effect. We can touch on some of the other risks that still remain. In particular, we'll talk a little bit about what's happening with the fiscal deterioration in the United States and how that risk is all of a sudden in the forefront. So for those folks who joined us for the previous two webinars, one of them we discussed the volatility compression, as John pointed out. Here's on the upper left is kind of the outline for that presentation. One of the things that we talked about is volatility shorting. It became so popular last year, and what happened to that? And we're going to talk about. We asked the question, what could disrupt the volatility gravy train? We said, it could be an event. We had that event, so we'll take a look at that. And then for those of us who joined us in January, we're going to touch on the political risks, which really resulted in fiscal deterioration in the United States, and we're going to talk about inflation and interest rate risks and how they impacted the stock market, and of course a little bit about the asset valuations and sentiment. Yeah, everybody was happy and nobody cared about valuations until one day they do now, all of a sudden. So that's kind of what we'll go through. So let's start with the market correction. So what started this correction? Depending on who you talk to, everybody has a different story. But here's the reality. It was really started, the market was already jittery going into the last employment report, which was the January employment report. And this is the chart that started it all. This is where things really fell apart. It was the U.S. average hourly earnings that jumped 2.9% versus the expectation of 2.6% in January. So basically suggesting a strong pickup in wages in the United States, which the market quickly interpreted as inflationary and proceeded to sell off. The interesting thing about that report, the wages report for January, is that it was flawed, and the market fairly quickly, analysts quickly realized that it was flawed. Wages didn't really go up that much. In fact, if you look at the upper left chart, shows wage growth for production and non-supervisory employees. That thing is still, showing wages growing at less than 2.5% a year. But if you look at the chart on the right, what it shows in January, the number of hours worked, and that dipped more than typically for this time of the year. So what happened? Well, January, particularly the early part of January, was extremely cold. We had the bomb cyclone, and the Northeast went into a deep freeze, and we had snow, and that resulted in a lot of people not coming into work. A lot of people weren't able to make it into work. Some places were shut down. Well, what does that do to the wages number? Well, if you have people who are on the clock, people who punch in the card and show up, they weren't getting paid, and that typically would be people who are low wage workers. Salaried employees, higher wage workers, management, who didn't make it, still got paid, right? And so all of a sudden you removed some of the lower wage workers from the calculation, which resulted in an improvement in wages, which is completely flawed. It's a defect a bug in the calculation. So wages are rising, right? They're rising at 2.5% a year, maybe a little higher, but not 2.9%. So that was a mistake that's going to get reversed probably in February, but the market didn't care, right? The market said, I'm spooked, I'm getting out. And so in the fixed income market, what was happening was the market-based inflation expectations jumped. All of a sudden, you started seeing inflation expectations rising above 2.5%, and that pushed Treasury yields higher. And even typically, what we've had over the past few months is the shorter end Treasury yields were rising, like a 2-year yield, because of the expectations of Fed rate hikes. But the longer end wasn't moving, which resulted in a flattening yield curve. But now all of a sudden, the 30-year Treasury yields started moving. And if you think about Treasuries, versus the stock market, equities are discounted cash flows, long-term cash flows, right? And if long-term interest rates rise, the present value of the discounted cash flows should, in theory, decline, and that was spooking the market. So here's a good chart, quite interesting. It says basically that the stock market tolerated yield increases for quite some time, for months actually. Yields were rising, and it was sort of the last few basis points of increases that what I call broke the camel's back, right? It just couldn't take it anymore, and it cracked. Basically, high yields all of a sudden became the boogeyman, and as a result, we had this breakdown in the correlation between the economy, where the economy is going, and the stock market. So the good news for the economy all of a sudden became bad news for the stock market. And part of the issue also was this notion that the federal government is on a spending spree, injecting huge amounts of stimulus into an already hot economy, which will cause the economy to overheat and do two things: force the Fed to accelerate rate hikes and push inflation higher, moving bond yields higher, and at the same time force the federal government to borrow more, creating huge amounts of Treasury paper out in the market, massive new supply, which we'll talk about it shortly. And that, of course, can be a negative for the stock market. We'll talk about that as well. So the stock market was pretty levered, and most people think of leverage in terms of margin accounts, and margin balances were very high. But leverage was also in the form of leverage ETFs, which very quickly delevered. You can see this chart shows the amount of capital that cleared out from leveraged exchange traded products in a matter of a week, basically. What was positive about this correction was the valuations. We talked about valuation risk, right? If you look at the green line, the green line shows the price to earnings ratio based on analyst forecasts for earnings for the S&P 500 companies. And so the price to earnings ratio was climbing through the end of last year, reaching sort of multi-decade high. The only time that was higher than this was during the dot-com bubble. And so this price to earnings ratio showed that the market was frothy. Valuations were off. Nobody cared. In part, the reason why people didn't care is, the tax legislation passed, and so all of a sudden everything was fine. And that the tax legislation did help tremendously in that it boosted projected earnings. And you can see the first drop at the beginning of 2018 in price to earnings ratio was due to improvements in earnings forecasts for the stock market due to the tax reductions. And then there's the second leg of the decline in price to earnings ratio, which was due to the correction. And all of a sudden, on Monday, when the correction really took place, valuations looked interesting. They all of a sudden look more like they were in 2016, a lot more realistic. So now on to the volatility unwind and what happened with what's called the big short unwind. Um, this chart shows the short interest in VXX. VXX is a exchange traded product which bets on basically buys and holds VIX futures. It's long VIX futures. And so there was this massive crowd of investors were shorting VXX and going through other instruments, including shorting VIX futures directly. But they had, within a year, you had a massive buildup of short interest in volatility products. For those of you who joined us on the volatility compression webinar, you saw this chart, which is the Credit Suisse Velocity Shares Daily Inverse VIX short-term ETN, which is an ETN that exchange traded note that bets against VIX, so basically shorts VIX futures. So if you have a note that shorts VIX futures, in a short position, there's clearly a serious downside in that as long as the volatility is declining or the curve is basically upward sloping, this product is going to make a lot of money. But if the volatility suddenly jumps quite a bit, there's an unlimited risk in that a doubling in the VIX futures basically can wipe out this product. And we talked about that at the last at this webinar discussion. So here's what it looked like in the fall, when even something like the North Korea nuclear test was basically ignored by the market later, and everybody continued to buy this product and making money in shorting volatility. So this particular product, you actually go long the product, and it in turn turns around and shorts VIX futures, which became a very popular investment. Its ticker symbol is XIV, which is the flip of VIX, the VIX. It's a very popular Credit Suisse product. But then this happened, and this was a watershed event, right? So basically, VIX futures doubled, and in a day, and that was the end of it. When VIX futures double, you wipe out these exchange traded products that are short VIX futures. This ended the volatility big short. In the futures market, if you look at what happened, you had speculative accounts, incredibly short VIX futures that go directly in short VIX futures and make a lot of money, and that got to a record late last year, the shorting, and then within a week, all of a sudden, the market reversed from a massive short to this huge long position. This is unprecedented. It's never happened before, this type of move, and it sent shivers through broader markets, including the stock market. People were just spooked by what's going on. This is not on the scale of, say, the subprime or anything like that, but when you look at something like this, people start to wonder what other repercussions this may have. It certainly had an impact on the equity volatility markets. So these are this is what happened to the, there's two large inverse VIX exchange traded products, and they both blew up. Basically, they lost most of their value. The Credit Suisse product was what's called accelerated. If you look at the Credit Suisse documents, if there's a big enough decline, the bank has the right to accelerate and unwind the note, and basically return whatever money is left to the investors. And I can tell you, there's not going to be a lot of money left on XIV, the first one on the upper left. The other one was structured a little differently, the ProShares one. It also lost most of its value, but it did not unwind, and it continues to trade through today. And of course, people are not too excited about going into this, but it has survived and will probably gradually creep up again. This event has dislocated completely the volatility markets. If you look at VIX right now, it is way higher. VIX and any S&P 500 implied volatility product is much higher than it should be relative to other volatility indices, right? So the chart upper left shows VIX relative to RVX. RVX is just like VIX, but it focuses on the Russell 2000, which is the small cap VIX equivalent. And you can see for the level of where RVX is, VIX is way higher, right? And that has to do with this massive unwind, because that's where the shorts were. They weren't in RVX, they were in VIX, and the unwind, it maintains an artificially high level of VIX because it continues and people are jittery. Similarly, if you look at VIX versus the MOVE index, MOVE, which is the Merrill Lynch Treasury Volatility Index. So relative to Treasury volatility, VIX is much higher. You can do the same type of chart by looking at implied S&P 500 implied volatility versus high yield spreads, for example, right? So all of a sudden, S&P 500 implied volatility is much higher than it should be for the level of high yield spreads. So high yield spreads widened, but not nearly enough to justify the elevated implied volatility of the S&P 500, which is caused by this big short unwind. And of course, here come the volatility-related scandals, similar to what we had with the subprime situation, where the unwind there caused all sorts of scandals. And now, we have allegations of manipulations of the VIX index itself, where people apparently were putting up quotes on S&P 500 options without real transactions, and those quotes were used in calculating the VIX index, resulting in potential, manipulation. So now let's shift to the other big risk that came out of our discussion in January, which is the fiscal deterioration. If you look at the United States, the federal government is one of the most leveraged governments in the world. In some ways, we're worse than Japan, depending on how you define it. But it's the only reason why the rating agencies are not downgrading the U.S. U.S. government debt, the treasuries, is because the U.S. economy is extremely strong. It's flexible and versatile, and it's highly diversified, right? And it's the U.S. economy that keeps treasuries from getting downgraded, not the federal government and what it does. This chart shows the general government debt versus the deficit, the financial balance. And things are getting worse. As we, in addition to the tax cuts, as we added the $300 billion in new spending a couple of weeks ago, the deficit is expected to worsen dramatically. We're going to be at 5.5% of the GDP in federal deficit within a year, and only getting worse from there. So that's here's some forecasts. We're also seeing, obviously the debt to GDP approaching 100% within a few years, certainly within a decade, and the cost of interest to the government rising rapidly, which is the lower right corner chart. It's going to become increasingly expensive for the government to cover interest expense, especially as interest rates rise. What does this mean for the markets and rates? Well, here's a projection of treasuries and where the additional treasury issuance that's going to hit the market, and it's going to be driven by a number of things, such as, and this gives you a nice breakdown. First of all, the Fed is now unwinding its balance sheet, so that adds some supply to the market. So that's the red. The tax cut is adding additional treasury issuance, and then the new budget deal is adding additional treasury issuance, and then there was already expected more treasuries coming to market over the next few years. And so there's going to be a lot of treasuries out there. And, we cross our fingers and hope that there will be buyers, whether it's domestic or international buyers. Maybe, yields are higher, there will be enough buyers to absorb this new supply. If not, we're looking at, much higher interest rates over the years. Do Americans care? This particular survey from Pew Research shows that less than half the Americans think that the budget deficit is a top priority issue. And that's why it was politically palatable to, give all the candy out, right? Let's do the tax cuts and let's do the budget deal and increase spending, because from the political perspective, politicians will not get punished for it; they will get rewarded, right? Everybody wants a handout. So that's the risk, right? And that's over time, this is going to be a real drag on the rates markets and ultimately, eventually, on the equity markets as well. There's one risk that is off the table, one of the risks we discussed last time, and that is the debt ceiling, right? The concern was they're going to hit the debt ceiling, there will be no deal, and we'll risk defaulting on either Social Security payments or Treasury securities. But that risk got kicked down the road for a couple of years as part of this budget deal. So we won't have to think about this problem, but it's going to come back. And of course, other risks still remain. There's still the geopolitical risks we talked about. Pakistan. I keep saying Pakistan is problematic, and nobody seems to really pay attention, but it is. Pakistan and India, both nuclear nations, and tensions could escalate. Pakistan was, I think the U.S. is looking at labeling Pakistan as a terrorist funding state, which creates all sorts of issues. And China is now involved in Pakistan. It's there are a lot of sort of geopolitical risks out there right now. And of course, trade continues to percolate, and that's going to simmer this year. So we just had, and again, people don't seem to pay much attention to this, but it's a potentially a serious issue. So the White House is threatening what they call a reciprocal tax on trade. So certain countries putting up pretty high tariffs on U.S. products, and this would be a retaliation, which you can argue that it's a positive ultimately for the U.S., but unless it escalates into a tit for tat kind of trade war, so that's something that's still a potential issue. That's all we've got for today. Thank you, and so maybe we'll take some questions.
Lev, again, thanks very much. This is always a plethora of information for all of us who listen in. On I think it was Monday, the White House sent Congress a $4.4 trillion budget proposal, right? And it outlined, cuts to domestic spending, but at the same time, large increases to the military spending. You talked about ballooning deficits, but overall, there was a lot of stimulus that was in that budget proposal, new spending, combined with tax cuts. We have a new Fed chairman. How's the Fed going to respond to all this government stimulus?
Yeah, so the Fed is now going to be under pressure, facing what could potentially become an overheated economy. So just to put this in perspective, the only times when this much stimulus was injected, and this is not including the White House budget proposal, this is just what's been passed already. Mm-hmm. The only time this much stimulus was injected into the economy, federal stimulus, not the central bank, was during the Vietnam and the Korean Wars, meaning that when we needed to fight, pretty sizable engagement, foreign wars. That was the only time we've seen this much stimulus during a strong economy injected into the country. And so if you think about it, an economy that's already running pretty hot, all of a sudden all this new money is going to flow into it. And people say, well, why can't the economy grow at a much higher rate? Why can't we grow at 5%? And the answer is that's pretty difficult, right? So the potential growth for the U.S. economy is limited really by two things. It's limited by the labor force growth and by the productivity growth. And labor force is basically, if you look at the prime age labor force in the United States, it has stalled. It hasn't really grown much in the last decade. So there isn't much increase in labor force. And in fact, given the tightening and potential tightening in immigration, which is being contemplated right now by the government, when we tighten immigration, you're going to have even lower growth in the labor force. Our natural rate of growth in this country is something like 0.2, 0.3%, meaning that without immigration, we're barely growing as a population, right? And so without that, your labor force is stalled and it's aging, right? As the population ages, the labor force will peak. It will basically no longer grow. And productivity has stalled as well. if you look at the last decade, productivity continued to slow, productivity growth. It will probably improve. People will make some investments, but certainly not enough for the economy to grow rapidly. And so those two things are the constraints on growth. So if you pour money into the economy that's at its or above its potential growth, what happens? Well, you have all sorts of bubbles forming in the asset markets. You have risks of inflation. You have other types of distortions. And so the Federal Reserve sees this very clearly. And so they're going to become more aggressive. And so a lot of economists are now saying this year we're going to see four rate hikes, which we haven't seen in a long time, 4 rate hikes in 1 year. And they're going to continue hiking rates more aggressively. So that's what I'm looking at, which means tighter financial conditions, and ultimately we're going to get to the point where rates rise so much that we'll have we could have a recession. So that's kind of where I see that going.
Got it. So we have new government stimulus. We've had a period of 9 years of significant government stimulus. We haven't had inflation, though traditional legacy economics would tell you that we should. Why aren't we seeing the inflation? Will we see inflation? What's happening here?
Yeah, so inflation has been relatively low for multiple reasons. One, it's a global economy, and globally, we just had weak demand, and we were importing sort of disinflationary pressures, right? So importing cheap stuff from abroad, and in addition to that, we had some slack in the labor force for some years, right? So we had people who were not on the labor force, and so if you want to hire somebody, you just bring people who are outside of the labor force and pay them, pretty low wages, and they will come in and work, right? And then so two things happened. The global economy is all of a sudden recovered, and so you have more demand globally. The dollar has weakened, and so our imports are all of a sudden starting to get a little more expensive, and this labor slack is starting to disappear, and so when you want to hire workers, you got to pay them. You got to pay them more, and so wages, they're not rising as fast as that first chart we showed, but they're climbing, and so what you have is an environment where inflation is starting to perk up, particularly in the U.S. It's not going to be a spike in inflation. We're not going to see that. But we are going to see a gradual increases, as we saw this morning. Inflation was a little higher than expected, and you saw Treasury bonds selling off in response. And this particular inflation report was driven by apparel. So all of a sudden, clothing prices, which were declining, all of a sudden popped up, in part because the weak dollar makes our imports coming into this country a little more expensive. So it's happening.
What does the Amazons of the world and information availability for everybody, the ability to shop around, and what is that? How does that counter inflation?
It certainly has. It's been a big driver of keeping inflation low. Because this competition from online companies, yeah, it created definitely has been a drag on inflation. You can look at Walmart, for example. Walmart is now has a massive database. It's trying to compete with Amazon. It's a massive database of users and products, and where knows exactly where the touch points are for it will price everything to the absolute lowest level to move the market, right, to move these products. So technology has had a tremendous impact holding inflation down. But when import prices are higher and everybody has to, raise prices simultaneously simply because otherwise you're not going to make margins, you have no choice. And so prices will gradually climb, right? It's inevitable.
Where do you think the markets are going to go the next 3 months, 6 months, based on all of this data that you're looking at?
Yeah, so I'm actually pretty constructive on the stock market. There are a couple of reasons. One is, again, you look at the situation of huge fiscal stimulus. All of a sudden, you have tax breaks and government spending, Pentagon spending, reconstruction of hurricane-damaged areas. What does that do? Well, it certainly has the effect of raising interest rates because there's just a lot of money sloshing around, and so it's inflationary. But where would you want to be in an environment like this? Probably three areas you want to be. Maybe in some commodities, right? So higher inflation typically is positive. Higher inflation and lower U.S. dollar, which is lower again today. You want to be in commodities, and not necessarily in crude oil because that's a whole other story, but generally in commodities. But there are risks to that. For example, China could slow down and it could drag commodities down. So then maybe you want to be in credit. Well, credit, where you want to be is kind of on the high yield end, junk bonds. But junk bonds are very interesting because, with all this liquidity, you're going to have fewer defaults, and so you could make money on high yield. But certainly, rising interest rates will make it harder for you to make money in investment grade bonds, for example. So where would you be then? It leaves equities. The stock market, at least for the foreseeable future, is the right place to be, I think. For me, valuations are back to more reasonable levels, and all this money flowing in, we'll have more rotation out of bonds into stocks. So I'm actually pretty positive on the stock market.
And how about our U.S. lower middle market and the business owners and firms there? We've here at Star Mountain we have our proprietary data set, which dates back to 2000. The data that we have, which shows minimal correlation between the U.S. lower middle market and the broader public markets. But ultimately, when you have inflation, there still is going to be some impact. Any thoughts there?
Yeah. So for people that have that don't need liquidity, right? Somebody who could put money away for years. I think private markets, particularly lower middle markets, on the credit side and the private equity side, are pretty interesting. Because, and it's something we didn't talk about, but yesterday we had the NFIB small business report out, and small businesses are ecstatic. I've never seen anything like it. Business expansion expectations is through the roof. Businesses are saying this is the right time to grow. Their earnings are up. Their optimism is tremendous. And
they're investing. They're investing money.
They're investing money, and they're growing. And guess what? As they grow, they're going to need capital. They're going to need equity capital. They're going to need debt capital. Now, there is a tax issue that came up, which is there's a cap on interest expense for companies, 30% cap on interest expense, that you can no longer deduct all your interest expense, which makes it more interesting than for companies to do different types of transactions, presumably convertible notes and things of that nature. But putting capital to lower middle market continues to be, you know, a very interesting area to be.
All right. Well, look, Lev, thanks a lot. Again, I know that we fired this up pretty quickly, but it was very timely, obviously, given your last two presentations. We appreciate it. Always good. And you know, we went over, but I don't think we didn't. I'm looking at everybody who's logged in, and I don't think we lost anybody. So everybody's very interested. You know, obviously. Thanks to everybody who attended, in addition to obviously Lev. Should anyone have any further questions or feedback, please feel free to email them to us at webinars@starmountaincapital.com. Lev, thanks very much.
Thanks, John. Thanks, everybody.
And everybody have a great Valentine's Day, and we will be in touch soon regarding our next webinar. Bye-bye, everybody.